Two stores, same street. Walk into the supermarket. Every beep of that scanner moves 4 accounts at once. The books update themselves in real time. Now the corner shop? No scanner, just a clipboard and one big December count that reveals everything. Same goods, same profit, 2 completely different sets of books. By the end of this video, you'll run both. And stay to the end. The whole of Chapter 5 fits on one cheat card. Every entry, both systems, one screenshot. Let's roll. For 4 chapters, our company sold time. Tonight we sell things. My students always thought merchandiser meant Walmart, but there are 2 kinds. A wholesaler buys from the factory and sells to businesses. A retailer sells to you. Neither one made the goods. Buy goods, sell the same goods. Pocket the difference. Meet Maple Street Electronics. Tablets on shelves, and the operating cycle gets 1 extra stop. Buy, shelf, sell, collect, cash. That shelf is where your money sits frozen. Merchandisers obsess over how fast it moves. 2 new players tonight. Inventory, goods held for sale. Where does it live? Balance sheet, current asset, right beside cash and receivables. It becomes cash within the year. Cost of goods sold, accountants say cost of goods sold. The cost of the goods that actually sold. An expense, income statement, right under revenue. And the sentence that unlocks the whole chapter. Inventory is the cost of what's still on the shelf. Cost of goods sold is the cost of what went out the door. Same goods. One question, did it sell yet? Quick trap. Every exam has it. Best Buy owns 3 laptops. Laptop A, sales floor, price tag. Laptop B, the accountant's desk, running the books. And C, a stack of printer paper. Work with me. A is inventory, bought to resell. B is equipment, same machine, bought to use. It gets depreciated, Chapter 3 style. The paper is supplies, consumed, not sold. The rule that settles every case. Classification never asks what the item is. It asks why you bought it. Intent decides, resale or use. Before any entries, the picture that runs both systems. The cost bucket. Beginning inventory plus purchases. Everything you could have sold. Cost of goods available for sale. Every dollar in that bucket has exactly 2 exits. Still on the shelf. Ending inventory. Balance sheet. Out the door. Cost of goods sold. Income statement. No third door. 4 variables. Hand me any 3 and you solve the 4th. Professors hide a different one every time. Lock the bucket in. Near the end of this video, the December count runs this exact formula as a machine. You'll watch it work. And Chapter 6 is built on nothing else. That checkout beep, what does it actually do? It charges the customer. Yes, and it updates the books. That's the Perpetual system, a continuous running record. 1 beep, 4 accounts move. Cash or a receivable comes in at the selling price. Inventory drops. The goods just left the shelf. Sales revenue rises, and cost of goods sold rises right beside it. So gross profit is born on the spot. Burn this in. 1 sale, 2 entries. Entry 1 records the sale. The money side, cash or a receivable in, revenue up. Entry 2 records the cost. Cost of goods sold up. Inventory down. The goods leaving your store. We'll write both of them next. Buy side first. Maple Street buys 50 tablets on account. $10,000. Official form. Always. Debit inventory $10,000. Credit accounts. Payable. And notice, no expense yet. The expense waits until a tablet actually sells. Then the truck bill arrives. The deal is F.O.B shipping point, so we own the goods from the seller's dock, and we pay the $300 of freight. Freight in is not an expense. It capitalizes. Debit inventory $300. Credit cash. Getting goods to your shelf is part of what they cost you. The whole F.O.B game in one sentence. Whoever owns the goods on the truck pays for the truck. F.O.B shipping point. Ownership passes at the seller's dock. The buyer owns the ride, pays the freight, and the cost capitalizes into inventory. F.O.B destination, the seller owns it to your door, and the seller's freight out is an operating expense, never inventory. Own the ride, pay for the ride. 5 tablets arrive cracked, 1,000 goes back. Debit accounts payable, credit inventory. In Perpetual, whatever changes the goods cost hits inventory directly. Now the invoice whispers, 210, net 30, and we pay on day 8, inside the window. Fill the entry and exam order. Step 1, debit accounts, payable, and careful, future CPA. Use the T account balance, 10,000 credit, 1,000 debit, 9,000, never the invoice. Step 2. The discount, 2% of 9,000, 180, credit inventory, cheaper goods. Step 3. Cash is the plug. Whatever makes debits equal credits, 8,820. The saga so far, invoice plus freight minus return minus discount. The shelf carries 9,120, hold that number. 2%. Who cares? Someone said it every semester. Watch. Skipping the discount buys 20 extra days. For 2%, how many 20-day loans fit in a banker's 360 year? 18 of them. And 2%, taken 18 times over, comes to 36% a year, a loan shark rate hiding in 2 little digits. And our own story is worse. We paid on day 25. That means we waited 17 extra days. And that little delay alone cost us $180 real dollars. The rule: always take the discount, even if you have to borrow the cash. Now turn around. We're the seller. And here's the heart of the chapter. 1 sale, 2 entries. We sell tablets for $9,000 on account, goods that cost US $5,400. Entry 1, the revenue side, at selling price, debit accounts receivable, credit sales revenue, $9,000. Entry 2, the cost side, at our cost, debit cost of goods sold, credit inventory, $5,400. The goods leave the shelf. The gap between the two numbers, $3,600, is gross profit, born instantly. Forget entry 2, and your books tell a fairy tale, the most common student error in this chapter. Now the givebacks, official form, every time. The customer sends 900 of goods back, debit sales returns and allowances, the anti-revenue grows. Credit accounts receivable, they owe us less. Goods resaleable, they climb back onto the shelf. Debit inventory, 540. Credit cost of goods sold, the reverse of entry 2. Then the money arrives, day 7, inside the window. Same exam method. Step 1. The T account balance, 9,000 minus 900, 8,100. Step 2. The discount, 2%, 162. Debit sales discounts, the contra grows on the debit side. Step 3. Cash is the plug, 7,938 lands in the bank. And notice, this collection entry never touches inventory, identical in both systems. Could we just shrink sales revenue and hide all of that? Management would riot, returns scream quality problems, discounts whisper about cash, so 2 new accounts, both contra revenue, both debit balance, sales returns and allowances, and sales discounts. Now watch the partial income statement build. Sales revenue, 9,000. Less returns, 900. Less discounts, 162. Net sales, 7,938, the first line of every published income statement on Earth, and you just built it from raw entries. Real accountant work. Now stack a whole year into the statement real merchandisers publish. The multiple step, a staircase with checkpoints. Net sales, 900,000, minus cost of goods sold, 420,000. Gross profit, 480,000. Divide it by net sales, a 53% gross profit rate. The number analysts watch like hawks. Your number now, future analyst, because a rate travels. Your store against Walmart. Keep stepping. Minus operating expenses, 180,000. Operating income, 300,000. The store itself, before the noise. Then the non-operating noise. Net income, 4 checkpoints instead of 1 blind subtraction. Now cross the street. The corner store runs periodic. No scanner, no running record. Inventory sleeps all year. So where do costs park? 4 special accounts, all temporary. Purchases, debit. Freight in, debit. An adjunct, the goods cost more. Purchase returns and allowances, credit. A contra, purchase discounts, credit. Buying, debit purchases, never inventory, and on a sale. Listen, credit sales revenue, and there is no entry 2. The beep goes silent. Next, the exact same story, both sets of books, side by side. Make the parking spots real, the same buy-side story, periodic form. The buy, debit purchases 10,000. Credit accounts, payable. The goods never touch inventory. The truck, debit freight in 300. Credit cash, the cracked tablets. Debit accounts, payable 1,000. Credit purchase returns and allowances. Parked, visible, waiting for the count. And payday 8, same T account discipline. 9,000 owed, debit accounts payable. Credit purchase discounts 180. And cash plugs the gap, 8,820. 4 spots, all filled. And inventory slept through every single entry. Remember that, the count is coming. Sell side, periodic. The sale, $9,000 on account, debit accounts receivable, credit sales revenue, and that's it. No entry 2, no cost recorded. The $5,400 stays invisible until the count. The return, debit sales returns and allowances $900, credit accounts receivable, revenue side only. Nothing restocks because inventory is asleep. And the collection, exactly the entry you already wrote. Debit cash, debit sales discounts, credit accounts receivable, identical in both systems. The whole periodic sell side, 2 entries and a nap. The whole chapter's entries, 1 board, buy side, 4 rows. The buy, Perpetual debits inventory, periodic debits purchases. The freight, Perpetual buries it in inventory, periodic parks it in freight in. The return, Perpetual credits inventory, periodic credits purchase returns and allowances. Pay in the window, both kill the payable, but the discount. Perpetual credits inventory, periodic credits purchase discounts. See the pattern? Perpetual's answer is always inventory. Periodic always has a parking spot. Sell side, 3 rows. The sale, Perpetual, 2 entries. Periodic, 1. The sales return, both debit sales returns and allowances. Only Perpetual restocks. And collecting cash in the window? Identical in both. 7 rows. Every exam entry in this chapter. December 31st. Clipboards out. Count everything. Units times unit cost. The shelf says 3,720. Now the machine. The most exam-critical framework in inventory. Card 1. Purchases 10,000. Minus returns. Minus discounts. Net purchases 8,820. Plus freight in. Cost of goods purchased 9,120. Freeze. The exact number Perpetual carried all year. Card 2. Beginning inventory 0. Plus the 9,120 minus the count. Cost of goods sold 5,400. Both roads identical to the dollar. The system changes when you learn the number, never the truth. So which system wins? Line them up. During the year, Perpetual keeps a continuous record. Periodic keeps nothing. Cost of goods sold. Perpetual knows it at every sale. Periodic deduces it once. Entries per sale, 2 versus 1. And the count, the subtle one. In Perpetual, the count is a check. The ledger says 70,000. The counters find 65,000. 5,000 of shrinkage exposed. And the books bow to reality. Debit cost of goods sold. Credit inventory. In Periodic, the count creates the numbers. Shrinkage hides silently inside cost of goods sold. A stolen tablet and a sold tablet look identical. Thieves love Periodic. The trade, Perpetual buys control. Periodic buys simplicity. Big store, scanners, corner shop, clipboard, exams, both. Your turn. 2 questions. Exactly how exams ask them. Pause now. 1. Sell merchandise for 2,000 cash. The goods cost 1,200. Write everything, Perpetual and Periodic. 2. Periodic books. Beginning inventory 12,000, purchases 60,000, returns 3,000, discounts 1,000, freight in 2,000, and the count finds 16,000 on the shelf. Find cost of goods sold. Ready? Perpetual. 2 entries. Debit cash, credit sales revenue 2,000. Then debit cost of goods sold, credit inventory 1,200. Periodic, entry 1 alone. The cost was bait. The machine. Net purchases 56,000. Plus freight in 58,000. Plus beginning inventory 70,000 available. Minus 16,000 still on the shelf. Cost of goods sold 54,000. You just did with a pencil what the scanner does all year. Future CFO. And if you want 10 more exactly like this, the quiz generator on the site builds them free, link below. Screenshot this, the whole of Chapter 5 on 1 card. Exam radar first. This chapter shows up 2 ways. Write the entries under a named system or run the 4-number machine. This card holds both. Left column, the buyer's entries, Perpetual and Periodic side by side. Middle, the seller's 2-entry rule. And the net sales family. Right, the machine, cost of goods purchased, feeding the cost of goods sold formula, and the multiple step staircase. 2 traps in red. Freight in never gets the discount, and entry 2 is the one students forget. And here's the card I promised you in the first breath, in 1 sentence. Inventory's cost is invoice plus freight in minus returns minus discounts. And every sale is 2 entries. Pause. Screenshot. Keep it for the exam. The printable version is on the site, free. That's Chapter 5 in 1 sitting, and both full lessons, Perpetual and Periodic, are linked below. If you're new here, subscribe. The whole accounting course is free. Mock exams, practice exercises, and the quiz generator for every chapter live on the site. All free. Link in the description. And next, Chapter 6 opens on a cliff. You bought tablets in January at 200, June 220, November 240. A customer buys one. Which cost just left the building? Two identical stores, two different profits, both legal. FIFO versus average cost, the inventory showdown. The shelf never lies, but the costing method chooses the story. See you there, future CPA.